You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to Investor Way with me, Sam Ball. It's the 20th of December 2025, and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Boohoo, AJ Bell, easyJet, Baltic Classifieds, Diageo. Our final company of the week is 3i. It's not obviously US, but it's we're doing 3i instead. So, John, do you want to start us off with Boohoo, a company we used to own?
Yes, so it was once one of our picks, and we discovered it kind of by doing the show, actually, and unfortunately decided to buy shares in it. The background, before I go on to the half-year results, was that it was when we started the show in the sort of aftermath of COVID, late 2020, and we've been following Boohoo a couple of times. Well, we'd done it a couple of times on the show. And it was quite interesting at the time because they were still growing revenue. They couldn't actually supply the demand that they had in the States. They were building new distribution centers. And the share price had fallen quite significantly. I think it had been one of those sort of kind of lockdown winners, but then it was falling. And I think when we looked at it on a valuation basis, we thought, gosh, I think it was about 17 times earnings maybe when we first bought shares in it, and couldn't really understand why that was the case. So anyway, we thought, well, hopefully this trend is going to, or at least with the share price, is going to reverse. We will take a position in it. And I think what we hadn't appreciated beyond the numbers was that they were lagging the overall trend somewhat, which was whilst Boohoo, as an online UK retailer, was kind of the lowest cost operator in the UK, but there were trends towards Shein and Temu, the big Chinese competitors, which probably if we'd asked the wags, they would have told us that that's where people were increasingly shopping. And that was something, as we didn't have any industry knowledge and weren't actually using these websites ourselves, that we missed. And I'll come on to the results now after just giving that bit of background, but the numbers had continued to deteriorate and that trend had basically continued with no sign of slowing down. So anyway, with that being said, half-year results of Boohoo. Revenue was down 23% to £297 million over the first half. Its Debenhams brand was the only area of growth, but this was more than offset by high double-digit declines in Karen Millen and its youth brands. The group reported an underlying operating profit of £2 million, compared with an operating loss of £9 million in the prior period. The improvement was driven by heavy cost cutting, which has seen its fixed cost base nearly cut in half. Free cash outflows improved from £39 million to £22 million, and net debt fell by £32 million to £111 million. Full year cash profit EBITDA is expected to grow to around £45 million against the £42 million expected, followed by a double-digit growth in 2027. And the shares were up nearly 15% in early trading. In terms of valuation, Boohoo has a market cap of £278 million and trades at 0.17 times forward price to sales, compared with the 10-year average of 1.68, and unsurprisingly, it doesn't pay a dividend. It's very difficult, I think, with Boohoo. I mean, really disappointing that the revenue has fallen again and by quite significant amounts. They are trying every trick in the book and they're trying to get operationally better control, cost cutting. However, my concerns would be that the trend, despite what they're predicting going forward, is just going to continue. They have a significant amount of debt on the balance sheet. And I think also they've got boardroom problems with Mike Ashley trying to take control. He's been beaten off before. But actually, the Debenhams brand is the one that seems to be doing better, which I think, if that's the case, is a concern in itself, because Debenhams has been very poorly performing over the last decade. So I don't see a lot to be positive about here. I suppose one thing that could help the group is if the government do crack down on these small parcels and the avoiding of tax by Temu and Shein, that could possibly could benefit Boohoo, but I certainly wouldn't be convinced. I think there's little here to be bullish about. I suppose some people might make the argument perhaps it's a value play here, but it would be far too risky for me. I'm well out of it. I must have sold the shares, at least 18 months ago, but I don't have a lot of confidence in the business turning this around in the longer term. Sam, what are your thoughts?
Pretty similar. So I think, interestingly, in terms of the Temu and the Shein comments about the VAT that they're not paying, it was announced in the budget that they are going to get rid of the exemption threshold for small imports on VAT, which is basically the loophole that they've been using, but that's not actually coming in until 2029. The way this is looking, Boohoo may not be around in 2029. I suppose it's probably going to be part of Fraser Group by then, isn't it? Fully. I think that's the only scenario where I can actually see it surviving. I think a full kind of takeover by Fraser's Group is probably, I think, the only thing that saves it. I really struggle to see it surviving as a standalone operation now. Yes, it's pretty cheap, but that free cash outflow is still a problem, and the business just continues to get smaller. So
yeah,
I wouldn't touch it, and I wish I never had.
Yeah, that's right. At least we sold for something.
That's true. Yeah. So what's the share price? 20p. So actually, we would have lost another kind of 50% third. I don't know, 35 to 50% if we'd held it. So
absolutely,
at least that's something.
Yeah. On to a much higher quality company, AJ Bell.
Yes, AJ Bell. So it's one we've covered before. I mean, for most followers of the show, they're probably aware of it because it is an investing platform. So AJ Bell, they have come out with their full year results, and revenue was up 18% to 317.8 million. Revenue per pound of asset under administration was up 0.7 basis points to 32.3 basis points. Profit before tax was up 22% to 137.8 million, and the profit before tax margin was up 1.4 percentage points to 43.4%. Diluted earnings per share were up 26%, and the total ordinary dividend per share was up 14% to 14.25p a share. It's also quite well covered. So total dividends 14.25p, diluted earnings per share is 25.56p, so plenty of cover for that dividend. Number of retail customers was up 18% to 657,000. Assets under administration was up 17% to 108.2 billion. And the customer retention rate, that was down 0.1 percentage points to 94.1%. That did used to be sort of in the 95, so it has been slightly drifting downwards. But if they're growing the customers by 18% a year from quite a high base now, I suppose you can't complain. So they've said the profit before tax margin of 43.4% demonstrates the strength of their scalable business model, driven by increased revenue margin of 32.3 basis points and operational gearing benefits after absorbing the impact of additional business investment. The final dividend up 14%. That actually marks the 21st consecutive year of ordinary dividend growth. And following the share buyback programme executed in the year, they've announced a further buyback programme of up to £50 million to be completed throughout the 2026 financial year. And that's on a market cap of 1.78 billion. They've highlighted the record assets under administration of 103.3 billion, which was driven by inflows of 7.5 billion and favourable market movements of 9.3 billion. And they've highlighted their Trustpilot rating of 4.9 stars. In terms of the outlook, they said the UK platform market continues to offer a significant growth opportunity, with over 2/3 of the estimated 3.7 trillion addressable market still held outside of the platform market. Our business investments have delivered record growth in 2025, attracting new customers across all age groups and strong lifetime values. Building on our success, we will increase investment in our brand and propositions in 2026 to accelerate growth. Management remains confident in the outlook. They're prioritising investment for long-term growth, with the operational gearing inherent in their business model providing opportunities for profit before tax expansion beyond the 2026 financial year. In terms of valuation, the business trades at a P ratio of 17.57 and has a dividend yield of 3.2%. And in terms of the share price, they're basically flat over the past 12 months. They're up 29% over 3 years, and they're flat over 5 years. And they're actually down about 12% over the last 3 months. I think these are a good set of results, actually. I think that customer growth is fantastic. They've always had really good customer growth, actually, but when we covered it a few years ago, it was off quite a smaller base. So I'd kind of assumed it would slow down, and that isn't really happening. It's still putting up some really, really good numbers off a much higher base. I think really these results kind of make me quite pleased, actually, that Hargreaves Lansdown got taken off my hands by private equity, which I took a 50% loss on. I do wonder what Hargreaves results would now look like if it was still listed. So they said over 2/3 of the addressable market still held outside the platform market, but I don't know how much that is going to come over. But I think they're clearly taking market share now from Hargreaves Lansdown. They were when we covered it, but it didn't matter as much because it was off a very small base. They're doing it off a bigger base now. I think for Hargreaves it would be a big problem because I use Hargreaves for my ISAs and I use AJ Bell for my SIP, and AJ Bell's fees, they are just lower. So I think if I still held Hargreaves, this would be quite a big problem. So I think I probably would have continued to lose money on it if I'd continued to hold it rather than have it bought off me by private equity. I think longer term, although the business is doing well, I think, the same argument that, John's historically made about it sort of being a commoditized product, I think that continues to apply. So I think really, really good set of results. But I think for me, it's not an industry I'd want to get back into. What do you think, John?
Yeah, I thought these were a really good set of numbers, and AJ Bell operationally, they're doing a fantastic job, really encouraging with the customer growth. And I think the other point that I was going to make, and I guess this is more on the bullish side for AJ Bell, is the changes in the budget. And if you're under 65, that you're not going to be able to put more than, is it £12,000 a year into cash ISA now?
Yes,
Yeah.
Assuming it gets implemented.
That is a big if, but assuming it gets implemented, £12,000, and you do wonder whether there is going to be, the behaviour or the customer response to investing more. And I suppose AJ Bell being one of those more trusted names, whether that would benefit from that sort of trend. There's no guarantee there, but that would be a question. And the other, I guess, question would be that historically with Hargreaves and AJ Bell, if you've had cash hanging around on the platform, obviously they're benefiting from that cash being on their platform. And historically, they haven't really paid you very much interest. If you've got cash that's going to be in, let's say, a stocks and shares ISA that is hanging around, the government seem to be suggesting that you're not going to just be able to collect the interest sort of tax-free on that anymore if it's in a stocks and shares ISA. So you do wonder how that is implemented, whether the companies or the platforms like AJ Bell have to pay the interest and then it's just subject to tax, or perversely, whether they don't then pay the interest and they benefit from having the cash, sitting unused on the platform in between times. You wonder whether that would be, a small tailwind for the business too. But I think the main point for me would be that it is a commoditized industry, and to that degree, kind of race to the bottom. It's very competitive. And you've got platforms like Free Trade and a whole number of others coming in, competing on fees and, trying to take market share. Now, at the moment, AJ Bell is still doing a very, very good job, new customers being brought in. But I guess that's one of the longer term concerns. It's difficult to know how it will play out, whether that is ultimately what happens and that it's a stock that you wouldn't want to be invested in, or whether, they're, I guess, that trusted brand name. And I guess if some of the, these new disruptors that are coming in don't actually in the long term turn out to be hugely profitable, and if they disappeared out of the market in the longer term, whether then your AJ Bells and your Hargreaves do actually have a bit of a renaissance for that reason. I guess the other positive thing to say about AJ Bell is it does have a number of managed funds. I appreciate the trend is more towards passive, but it does have some managed funds and it does have an advisory service in it as well. So it is a little bit more diversified. It's not just or purely the platform business, albeit that's most of the business, but it's got a little bit of diversity there. In terms of its valuation, 17 and a half times forward earnings, I don't, for this type of business, albeit the point I made about it being commoditized, with the numbers it's putting up, it actually seems, I think, fairly reasonably priced, and it's got a dividend as well. So it wouldn't be for me, but I don't think the valuation is terrible by any stretch.
I think it's a case of growing into its valuation, though, because that flat over 5 years, it used to be quite expensive. It was kind of in the 30s when we first were covering it. And the price hasn't really changed, but I think the business has sort of grown into its valuation, which is the risk with it. It's kind of similar, actually, to what I had with Hargreaves.
Yeah.
With Hargreaves, there was never really any problem with the numbers it was putting up. The growth was slowing, but it was never declining. But that valuation just kept getting compressed. And that was where I lost the money. It was on the multiple going down. Should we move on to a less attractive industry?
Yes, absolutely. So, well, less attractive to us anyway. So, I think any airline we haven't been particularly positive about, but easyJet had their full year results out a couple of weeks ago, with full year revenue rising by 9% to £10.1 billion, which was in line with expectations. All business areas saw growth, with the holiday segment expanding at the fastest pace, up 27%. Increased airline revenue was helped by capacity growth and fuller planes. Pre-tax profit also grew by 9% to £665 million against £653 million expected. And the uplift was driven entirely by the holiday segment, as ongoing investment in the airlines business weighed on performance. Free cash flow improved by £54 million to £717 million, and the net cash position increased by £421 million to £602 million. In the first half of 2026, losses are likely to get worse as investment in the airline segment continues, and full-year capacity is expected to grow by around 7%. A final dividend of 13.2 pence per share was announced, which is up 9%. And the shares were down about 1% in early trading. In terms of valuation, easyJet has a market cap of £3.85 billion and trades at 0.93 forward price to book, compared with a 10-year average of around 1.5. It's got a prospective dividend yield of 3.1%. I suppose on the surface, these results seem good, with the full year revenue rising by 9%. I think when you look at it a little bit more, though, and the thing that always is, I guess, the fundamental issue with airlines is that you've got this huge capital expenditure and you're seeing that they're expecting that to hit them. That, for me, is always one of the big difficulties with the airlines, the huge capex that's going to be required for planes, new planes, maintaining planes. The other thing to say is that with oil prices being, by historic standards, lower, they've benefited from that. But should they go higher? Should things in the Middle East escalate? Should OPEC decide to tighten things further? Then there's nothing easyJet. I mean, I appreciate they can hedge to some degree, but there's nothing that they can really do about that. And then that just does hit them. So I think their issues, obviously it's encouraging that the holiday segment is been expanding. And I guess that, again, is something that's quite cyclical, depending on overall consumer sentiment. I think on the surface of it, the results look okay, but my concern, as with all the airlines, is everything else that goes with it, the cyclicality, the capital expenditure, and yes, the valuation isn't very commanding, but I would just, as a sector, I would be staying clear of it. So I think, staying clear. I would, to be fair to management, say that they do seem to be doing a good job with what's within their control. They're squeezing as much as they can from the business with the ancillary revenues. And I think you see that, sometimes we go away to different places in Europe. We'll often go on an easyJet or a Ryanair flight, and you are charged for absolutely everything. Unless you are taking nothing with you and you're just going in the clothes you're wearing, then everything else is an extra. And you do see that they get as much as they can from that. often try to upgrade you to some sort of you call it premium on a low-cost airline, but, jumping to the front of the queue, having a bag, all of those sorts of things. So they do seem to be doing a good job there. But for me, it's the sector that is pretty much uninvestable. Sam, what are your thoughts on these results from easyJet?
Pretty similar, without sounding boring. I think they're a good operator in a tough industry, but unfortunately that industry is just uninvestable, so don't really have anything further to add.
Okay, fine. So on to something that is very much investable and a company that we both like, Baltic Classifieds.
Yes, and it might be more investable than the last time we covered it, actually. So Baltic Classifieds Group, for anyone who's not familiar with them, we have covered them before. It's easiest to think of them probably as the Rightmove of the Baltic, the Auto Trader of the Baltic, and also the Indeed of the Baltic. So they have come out with their half-year results, and revenue was up 7% overall to 44.8 million, and all these figures are in euros. If we split by division, auto revenue was flat at 16 million, real estate revenue was up 20% to 13.2 million, jobs and services revenue was up 7% to 8.9 million, and generalist revenue was up 4% to 6.8 million. So in terms of the generalist section, which I didn't mention, it's easiest to think of that bit as kind of like a Craigslist/eBay of the Baltic. So quite nicely diversified across the segments. So of the 44.8 million revenue, 16 auto, 13.2 real estate, 8.9 jobs and services, and 6.8 generalist. Operating costs were up 8% to 9.7 million, excluding depreciation and amortization. And the operating profit was up 18% to 31.1 million. And that's 31.1 million of operating profit on 44.8 million of revenue. So I'll just work that out actually, but 69% operating profit margin. So it's very, very much in line with Rightmove. If we look at the EBITDA, which I think the main difference in that is just the depreciation and the amortization. So for acquisitions and stuff, that amortization has been added back. That would then give an EBITDA margin that's a bit higher. That's at 78%, but I prefer to use the operating profit. The operating profit is high enough anyway. They've given adjusted operating profit that's also a bit higher, but again, the operating profit is so high, I don't really see any need to even look at the adjusted. Profit for the period overall, that was up 22%, and the adjusted net income was up 9%. Basic earnings per share was up 22% to 5.5p a share, and the adjusted basic earnings per share was up 10%, 6.3p. Traffic on their websites averaged 58 million visits per month, which implies the entire Baltic population visited their sites 10 times every month. During the half, average revenue per user increased in all the business lines, 16% for real estate, 13% in auto, 5% in jobs. Cash generated from operating activities were up 4%, with cash conversion rate maintained at 99%. They voluntarily repaid 10 million of debt during the half. 6.4 million was returned to shareholders through ongoing share buybacks, and that is on a market cap of 949 million, so very, very small actually. They've maintained a strong balance sheet and transitioned to a net cash position during the period from a leverage ratio of 0.1x at the end of April. I don't really think that leverage was a problem anyway. The dividend was up 8%. They've said, we've maintained our strong leadership position over the nearest competitor across all our largest sites, which together account for 90% of group revenue. Autoplius was at 6x, the nearest competitor, and that's the same as last year. Auto24EE, it was at 31x, and that was down a bit from 36x the last year. Araudas was at 48x, and that was up from 27x. KV.EE plus City24.EE was at 16x, and they were up from 13x. CV Bankas was at 5x, and that was flat. And Skelbiu was at 30x, up from 21x. So overall, it seems like they've actually increased the market-leading position. They've said faster real estate selling time combined with stronger uptake of premium, longer duration packages resulted in real estate inventory declines of 7% in listed and 5% in active ads. Car transactions in Estonia have dropped by half since the vehicle transaction and ownership tax was introduced 11 months ago, while Lithuania recorded an 8% increase year on year. In total, listed ads declined by 29% and active ads were down by 26%. Year-on-year growth is expected to resume in January, reflecting the benefit of easier prior year comparisons. The uptake of consumer-to-consumer active ad services was up 11% due to growing usage of services and higher uptake of longer duration packages. Listed paid ads on our generalist platform, which is competing with our market-leading verticals, declined by 15%. Altogether, with free listings, our inventory level is as high as ever. For the outlook, they said, despite record inventory comparables and challenges in the Estonian auto market, we expect revenue growth for the second half of the year will be above that of the first half and will accelerate into double digits for 2027. Real estate and auto are expected to lead this growth. Jobs and services and generalists are expected to grow at a more moderate pace. We remain cautious on inventory trends. We intend to implement product improvements and price changes for consumer to consumer in spring and business to consumer in autumn. With lower revenue growth and continued investment into our product, some EBITDA margin compression is inevitable. But even with investments into data and AI, our EBITDA margin is expected to continue in the mid-70s. We intend to continue to return meaningfully all our excess cash to shareholders in a timely manner, of which at least 1/3 will be through dividends. We could be debt-free by the end of the year, so shareholders can expect an update on capital policy by the time of our full-year results. In terms of valuation, the market hasn't liked these results at all. I think it's mainly because of the auto, which seems to be outside of their control, but it has had an impact. So in terms of valuation now, it trades at a P of 20 and a dividend yield of 1.62. And the share price is down 44% in 6 months, which is probably about the last time we covered it. This is a business we have covered for a long time. We've both really liked it, but I think it's had a PE of around 35, 40, and we've just not been willing to pay that. I think the reason has partly been that we don't know how saturated it already is in the Baltic. I'd guess pretty saturated based on the dominance. It might be the market's continuing to get bigger and they'll grow with it, but I don't think there's much more market share for them to take. I also struggle to see them expanding outside the Baltic. Not that it seems like they're attempting to. I think they seem quite happy with that niche. Whether they could go into like maybe nearby countries like Finland or something like that, I'm not sure. But I think it's reasonable to assume they're going to stay in the Baltic. So in terms of the total addressable market, I've always found that really difficult to actually figure out how close to saturation they are, which is why I've always felt like, well, if I'm going to get it, it has to be a reasonable valuation. I think we're now seeing that. To me, I think this business still seems pretty strong. I think that's a really solid set of numbers. It's a business that I think is still growing. The margins are fantastic. Yes, it's had some trouble on the auto side, but that's because of a government policy. And longer term, I don't think it'll make a huge difference. Even if it does, it's just such a well-diversified business. And it's actually better diversified than Rightmove and Auto Trader because it's got those other parts to the business. So I actually think, even if the auto was a problem, I think it's shown itself to be a high enough quality business that I'd be comfortable that the other parts of the business will make up for it. Unfortunately, personally, I need the cash for a potential house purchase next year. So I'm not really opening new positions. However, I have to say this has really, really tempted me. I think at a PE of 20, when the results are basically fine and it's just a government policy that's had a temporary impact, I think at 20 times earnings, I think it's just, I think it's really, really attractive. What do you think, John?
Yeah, no, I would agree with you, Sam. I think for me, it's been the valuation previously. The point about how saturated it is and how big the addressable market is, I think is a fair one. But I think valuation has been the overriding worry with it. And to be fair, if you had bought it, 30, 40 times earnings, you have seen quite a big correction. And as you say, it's nothing the fault of Baltic Classifieds when it comes to the auto division. And hopefully that is just a temporary impact. But I would quite seriously look at taking a position now. It's got to that level. So yeah, fortunately or unfortunately, I'm not yet at the stage of buying a house, so I may well take a position here.
I think as well it's interesting that it's quite I know Rightmove's come down since we last covered it, but it's cheaper than sort of the valuation we've been used to seeing from Rightmove.
Yes,
I think
absolutely.
It's probably still going to put up better numbers than Rightmove going forward.
Yeah.
So I don't think it's quite as saturated yet, is the impression I've got.
Yeah.
And as well, I think it is just better diversified. So I think you're arguably getting a slightly better business because when you look at those margins, they're at Rightmove levels. And it's hard to find another business that does that.
Absolutely. Shall we move on to Diageo?
Absolutely. Another quality business that's fallen.
Yes, no, it is. So it was really one of the darlings of the FTSE 100, probably for most of the last decade or so. It fell on hard time. They had the unexpected death of chief executive. It's probably getting on for 2 years ago now. Perforated duodenal ulcer and sadly died. And then you had Deborah Crew coming in and they were large shoes to fill. They had some operational difficulties, particularly in South America. There's also been quite a lot of publicity about Terry Smith selling his stake in Diageo. And that was really on the back of the concern that Gen Z or Gen Z are not drinking as much, and therefore the volumes of Diageo brands, they're not selling as much. And that being coupled with GLP-1, so your sort of Ozempics and Mounjaros, the worry there that, again, that's going to impact on behavior and volume, people living healthier lives. To a degree, Diageo have felt that certainly with people drinking less, that wasn't such a problem in the sense that they could sell them more premium versions of their drinks, have higher margins, and address things like that. Anyway, what's happened was after Deborah Crew left, they've been searching for a chief executive, and we've been mentioning that for the last few quarters. The search has now come to an end, and the incoming chief executive is Sir Dave Lewis, who was previously at Unilever for about 3 decades, and he was known as Drastic Dave. I think where I've known him better is when I was a Tesco shareholder, and he was a Tesco chief executive from 2014 to 2020, when he really got to grips with Tesco, turned it round after the accounting scandal, the horse meat scandal, and as we've covered over the last couple of years, Tesco now operationally absolutely fantastic, best supermarket, and the returns have really improved. So Dave Lewis has come in, and he's, for reference, also been on the boards of Haleon and PepsiCo, but best known for Unilever and Tesco's. And he is basically going to be taking the reins, and the CFO is going to go back to being the CFO because he was temporary or interim chief executive. And the market reaction has been really positive. Shares were up about 7% on the news of Dave Lewis taking the reins. And I'm very optimistic that he will be able to turn Diageo around and get those brands, because they've got $13 billion brands, which is quite incredible. And you go through and you read some of them, and I know we've mentioned it on the show before, but they've got Johnny Walker, they've got Guinness, they've got Tanqueray, Bailey, Smirnoff, Captain Morgan, Don Julio Tequila, Gordon's, Aviation Gin. What else have they got? Hobhouse, 13 Lager. They've got Pimm's. Got a huge number of some of the top brands of spirits. And then obviously in the form of Guinness, an iconic beer or stout brand. So they've got a fantastic portfolio that they could certainly do, I think, a lot more with. They've also got a 34% stake in LVMH's drink division, which includes Moët, most famously. I think there's a lot that he's going to be able to do with the company and get back essentially to its former glory, albeit in a more difficult market where people are drinking less and there are weight loss injections. In terms of the market cap, it's only £37 billion and it trades at 13.4 times forward earnings, which is almost unheard of when it comes to a business with the quality of Diageo. And it's got a prospective dividend yield of 4.7%. It does have a fair bit of debt. It's got on the balance sheet about $21 billion. Or 3.4 times adjusted profits, which they are looking to sell off non-core assets. I'm optimistic. I'm still a Diageo shareholder. I have been topping up in a small way on Diageo over the last year, and I would be bullish about it going forward. Sam, what are your thoughts on the appointment of Dave Lewis as the new chief executive?
Yeah, very, very positive. I think it's been a few weeks now. But yeah, I think he's probably one of the most talked about CEOs in terms of that we've covered on the podcast, mainly from the time he was at Tesco. But yeah, I think historically he's been a very efficient operator. I think he's hopefully what Diageo need, but as a shareholder, I couldn't really be happier with it. What do you think as well then about the sale of the African breweries?
I think it's probably reasonable. I think they are They were lower margin, lower growth, and I suppose when you look at volume sales, generally the lager brands have been slower, and we've seen that when we've covered other businesses like Heineken, for example. The higher margin, higher quality part of the business does seem to be the spirits. I think they are very much non-core assets, so I wouldn't be as concerned about that. And I suppose as the debt is getting more expensive, it doesn't seem unreasonable to do that. When we've covered Unilever and they've sold off what they think are non-core, I have been slightly less keen. And I think in an ideal world, I probably would rather hold on to them, but I'm not overly concerned. I think if they were selling off any of those spirit brands, or if they were selling any stake in the LVMH, that would be a much bigger worry for me. What are your thoughts?
Pretty similar. I mean, I think for me, when I look at it, it's basically determined entirely by the name of the brand. The brand gone, I don't really recognise. They're not like the billion-dollar brands that you've referred to. It's not like they're selling off Guinness or something like that. It is very much a non-core part of the business. Whereas if you compare it to like Unilever's strategy, where they're selling off very recognisable brands that I think are really good brands, but maybe slightly low margin, I do disagree with that a lot more. But yeah, with this, I don't really have an issue. I think them focusing on those core brands that are going to earn them the profits going forward, I think I've got no issue with that. Obviously, Dave Lewis has come in. He's got to start cutting some of the bloat, I think. And I think it's probably quite positive to see. I mean, this deal was probably in the works before he came in, you'd expect. But I think it's quite positive that he's coming in and he's quite happy to get rid of stuff that isn't really performing straight away. So yeah, so I've got no issue with it. Yeah.
The other thing that's, I think, interesting is that whilst a lot of the other brewers have been struggling a bit more, I think Guinness has actually had a bit of a renaissance, and it seems to be trendy with Gen Z at the moment. So that is, encouraging for, I guess, the one kind of core beer brand that they have. And also you've got the Netflix TV series on the Guinness family, which I wonder whether that will feed through at all as well. So that's, I think, certainly all very positive.
Should we move on to 3i then?
Yes. How are they doing? We haven't covered them for a while.
I don't think we've ever covered them, actually. I think it's
okay, sorry.
So it's we tend not to do investment companies that much, but this one was a listener request, so we've managed to fit it in as a Christmas present. So 3i, I'm sure a lot of people have heard of them. They're quite a well-known investment group, but for anyone who doesn't, they basically focus on private equity and infrastructure deals. They're founded in 1945. If we go through some of the private equity deals, I mean, a lot of it, I'm going to be honest, I don't really recognise the brands in terms of businesses I've invested in. Aspen Pumps, Basic Fit. I'm just picking some at random. There's loads on the website. European Bakery Group. Gantz, that one I do recognise, actually, in fairness. I think that's the only one. Congas Slod, Magnitude. It does go on and on. They've got absolutely loads of these. And then in the infrastructure products they've invested in, again, I mean, the main one actually that I recognise, they've done some stuff with Cross London Trains, but they do actually, I think they built Belfast City Airport, which is an airport you were unfortunately too familiar with when we went, John, because you got stranded there.
Absolutely.
If you're taking the time to wander around it, that was 3i that owned that. And then lots of other kind of infrastructure products that, again, don't really recognise. I suppose I'm not really that hot on my random parts of British infrastructure. They have come out with their half-year results, and total return was up from 2 billion to 3.3 billion. However, as a percentage return on the opening shareholder funds, it was up 13%, and that compared to 10% a year ago. The dividend per share was up from 30.5p to 36.5p, so about a 20% increase. The gross investment return was up from 10% to 13%, and the gearing was down from 4 to 3%, so that's pretty low. In terms of the private equity business, they've said Action continued to trade strongly. Action, I should say, actually, that's a Netherlands-based discount retailer specialising in non-food products like household goods, cleaning supplies, DIY items, seasonal decor. And this is one of their biggest holdings. So they have 3,000 stores across 12 European countries, including Netherlands, France, Germany, and Spain. it seems to me like I kind of get kind of B&M vibes from it, actually, in terms of sort of the product range. So they've said Action continues to trade strongly, and several of our other large portfolio companies are showing good momentum against a challenging macroeconomic and geopolitical backdrop across Europe and the US. 98% of our private equity portfolio companies by value grew earnings in the 12 months to June 25. In September, they acquired 2.2% of Action's equity from GIC in exchange for newly issued 3i Group shares. And as a result of this consideration, their ownership of Action was up to 60.1%, so the majority owners of it now. They've said in October 25, Action successfully completed 2 financing transactions, and this took the ownership position up to 62.3%. In the 10 reporting periods ended 26 October 2025, Action's net sales and operating EBITDA were 17% and 15% ahead of the same period last year, and like-for-like sales growth over the same period was 5.7%. At that date, Action's cash balance was €579 million. In terms of the infrastructure business, they've said our infrastructure business generated a gross investment return of €139 million or 9%. This was primarily driven by a 14% increase in 3i Infrastructure PLC's share price in the 6-month period to 30 September, and the underlying portfolio continued to perform well with a significant valuation uplift in TCR. As they've said, in the 10 reporting periods ended October 25, Action generated net sales of 12.5 billion and operating EBITDA of 1.75 billion. Over the same period, like-for-like performance was 5.7%, and like-for-like performance was softer, reflecting higher prior year comparables, like-for-likes, and softer seasonal sales this October. Across all Action countries, France stands out as the weak spot for the consumer, although its like-for-likes remain positive year to date, which we consider a strong performance relative to the rest of the non-food discount sector. So the market didn't like these results. In terms of the valuation, the business trades at a premium of 13% to the net asset value, which I think is quite unusual, but usually a sign of quality. However, that was over 20% prior to these results coming out, and the dividend yield is at 2.23%. So the reason the market didn't like the results is because of that warning with Action, and specifically the French division. So Action accounts for about 76% of the private equity segment, and the private equity segment is over 92% of the overall business. So it basically means about 2/3 of this at least is actually driven by Action. In terms of the premium to net asset value, you can't actually buy Action. It's not publicly listed, so you couldn't save yourself 13% and buy that instead. But I think for me, historically, it might have been a great operator, but I'm not hugely interested in investment companies anyway. However, when kind of 2/3 of the portfolio is in a discount retailer that I don't really know anything about, I just wouldn't be interested. I think even if I did know about it, it's probably not a business I'd be that interested in anyway, just because of that retail exposure. But yeah, when it's a Dutch one that I can't really visualize, I wouldn't really want that to be such a large proportion of the business, because really you're kind of just buying Action, but with a few other bits thrown in. So yeah, not for me. But historically, it looks like they've been a very, very good operator. So it might be that they can turn Action around and they'll move on to the next thing with loads of cash and do really well. But it doesn't particularly interest me. What about you, John?
Yeah, no, I would be in the same camp as you. And for that reason, that such a large exposure is Action. It's interesting, actually, if you go back, so pre-2014, they owned Pets at Home for about 10 years.
Oh, that is interesting.
And then they were the ones who then spun it out and listed it, and it had its IPO in 2014. So
We probably should have kept that.
yeah, well, exactly. I was going to say, if it were Pets at Home replacing Action, and we were 10 years ago, then I think we may be having a different conversation. But yeah, not one for me at the moment.
Right. In that case, then, of the 6 businesses we've covered this week, Boohoo, AJ Bell, easyJet, Baltic Classifieds, Diageo, and 3i, which do you like the most and which do you like the least?
Oh, it's quite an easy... Well, actually, I say it's quite an easy one. I think because I already own Diageo, then I'm not really thinking about that, because I do really like it. I think it's an attractive valuation. But for me this week, as a company that I don't yet own, Baltic Classifieds looks attractive at its current valuation. So I'm quite excited about that one, actually. In terms of last, good question. I would probably actually go for Boohoo because I don't like the airline industry, but I think Boohoo is going to go to zero at some point in the next 5 years. So, and I don't think that's going to be the case with easyJet, even if I don't like the industry.
Without being boring, I would actually agree. I think if I had the capacity in my portfolio, I'd be adding Baltic Classifieds. I suppose it's no spoilers, but I think it's probably quite likely that we at least discussed adding it to the fantasy portfolio. I'd be surprised if that's not a discussion that happens. And then last year, Boohoo, I think just totally uninvestable. I think easyJet's uninvestable, but at least it seems to be operating well in a tough industry, whereas Boohoo is operating poorly in a tough industry. So for that reason, it would be Boohoo.
Okay. Thank you very much for listening, and we will see you for the Fantasy Portfolio special.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.